The use of trend lines in real-time trading is one of the important features that traders use to execute trading, especially for the newcomers who enter trading for the first time. It can never be overemphasized. Trend line trading strategy is one of the basics that every new trader should understand. And this brings us to understanding how to apply trend lines in trading. So with that being said, let's dive into the video.
Hey guys, in this video today we will show you our key trend line strategy that no one talks about. By the way, my name is Nsika Kubara from Edumers Forex Academy, and today I'll be teaching you with the laptop version of the trading app we use. But if you are just starting out as a beginner and you don't have a laptop just yet, then you can just click on the first link in the description of this video to get access to the real website of this platform and create an account with your mobile phone to follow along with us as we proceed. There are so many fake scamming trading platforms all over the internet nowadays, so you should be careful with the trading platform you choose to avoid gambling with your capital as you are about to start this journey with us. Make sure you choose a platform that will allow you to withdraw your investment anytime you want to. Now, to get our full guidance on this issue, you can just click on the first link in the description of this video to watch how we go about it as well. Alright, let's get down to business. So first, what are trend lines? A trend line is a line we draw on our chart that connects the swing highs and the swing lows during a trending market. So here we have a clear downtrend, we have a run, a pullback, a run, a pullback and a run. At the bottom of each run, before the pullback begins, is what we call a swing low. At the top of each pullback, before a run begins, is what we call a swing high. What this means is, in an ideal downtrend, price will be making lower highs and lower lows. Now, a trend line is then applied to connect the swing highs along the top and swing lows along the bottom. So let's move up to an uptrend. Here we have a clear uptrend. We have a run, a pullback, a run, a pullback, and a run. At the top of each run, before a pullback begins, is what we call a swing highs. At the bottom of each pullback, before a run begins, is what we call a swing lows. So what this means is, in an ideal uptrend, price will be making higher highs and higher lows. Now, a trend line is then applied to connect the swing highs along the top and swing lows along the bottom. Now, this is an important point. Price won't always move this smoothly in trending market, but we are showing you this as a reference to what an ideal trending price movement looks like. So why exactly do we draw trend lines? The first reason is because trend lines can act as form of support or resistance. Along the top, the trend line acted as resistance when price touched it, and along the bottom, the trend line acted as support when price touched it. Now, you don't enter trade blindly just because price has touched a trend line. You always wait for price action in combination with other factors which we'll get into later in this video. Now, the second reason we draw a trend line is because a break of a trend line can signal a possible trend change. So in a downtrend, we have our trend line placed above the trend. Once price breaks this trend line, it can signal a possible trend change to an uptrend. Now vice versa. In this moving uptrend, we have trend lines placed below the trend, and when price breaks this trend line, it can signal a possible trend change to a downtrend. So again, you have a moving uptrend and we have our trend line placed along the bottom of the uptrend. Once price breaks this trend line, it signals a possible trend change to a downtrend. And again, once this downtrend starts, we put a trend line above a moving downtrend, and once price breaks the trend line, it signals to us another possible trend change to an uptrend. Again, here were your trend lines before you hit your breaks, and then trend changes. Now, this is a very important point. What we just showed you is what occurs in an ideal situation, but it's not the law. You need to pair these trend line breaks or ejections with key price action factors before looking for a trade entry, but we will get into it later in this video. So now you know what trend lines are and why we apply them into our charts. Let's go through in depth how to draw trend lines effectively. First, let's go to the context we follow when drawing trend lines. 1. You need a minimum of 2 touches to be able to draw trend lines. The more touches, the better, but more touches does not guarantee that it will hold the next time around. Number 2. Trends don't always move smoothly. They are often choppy and imperfect. Number 3. Treat trend lines as areas, meaning use them as guardians for your overall analysis, not the law. Number 4. Don't force trend lines. If they are obvious and helps your analysis, draw them in, but if not, leave them out because they won't always be suitable price movements where you can draw a trend line on it. By the way, don't forget that there is an ultimate trading ebook that works in combination with this video, and with this ebook you will be able to learn when to easily enter a trade and when to exit from the trade to ensure minimum losses with maximum profits. This ebook will help you understand forex trading from scratch, starting from your need to understand the fundamental concept of supply and demand that governs forex trading as a whole, including how to avoid false breakouts while trading, to how you can manage your risks, plus so many other important topics that we can't simply cover on this short video at once. It is an ultimate ebook that will surely expose you to the secret of becoming a professional forex trader that can manage both psychological and live trading risks to eventually become a professional daily trader with the highest possible sense of confidence needed in the game. So to get this ebook, contact Johnson Job through the WhatsApp number on the screen or purchase it directly from our official website at edumers.com and download it into your phone to proceed with your studies immediately. So now let's start simple with what ideal best case scenario trend line will look like. Now here is your con moving down trend. You click on your line drawing tool, start from past of your swing high and drag the line down, connecting the 2 points. Also, make sure when you draw your trend line to have it extended further down, because if price makes it back after this trend line in the future, you want to have it ready as a reminder to look. So here is where your last trend line that would have been drawn before price broke the trend line. Now if you want, you can also draw this longer term trend line along these higher points like this. So next, here is your moving down trend, and again we connect the swing highs along the top and the swing lows along the bottom. So next, this is an important point we want to discuss. There isn't always a trend line you can draw, as there isn't always going to be suitable price movements for a trend line to apply to it. So to the lap here, we have a good price movement, or you would have had 2 trend lines applied before price broke the bottom trend line and started a downtrend. But now looking at the coming trend, there isn't a suitable price movement to apply a trend line. You could apply a super tight trend line like this, but that does not help your overall analysis. So in this case, we leave it out. So let's get into imperfect trend line. So a type of imperfect trend line you will often see is when not all the points are touching. What this means is when you draw a trend line, you wouldn't always be able to connect all the swing highs and swing lows. So in that case, just draw your trend line where it can touch the most amount of points and leave the rest out. So here is a clear moving downtrend. Let's go ahead and apply our trend lines where it can get as many touches as possible. Now all these points here all touches the trend line, but these points here do not touch. That's imperfectly fine, because again we use trend line as guidance. we don't use them on their own for trade entries. So let's go to another example. We have a clear moving down trend here. We place our trend line along the top connecting the swing highs, and we place our trend line along the bottom connecting the swing lows. Now again, notice the points that we were able to connect with the trend line and the points that didn't quite reach the trend line, which again is fine. Now these are few questions we often get asked. Do you draw your trend lines through the candle closes, candle bodies, or weekend? At this point, you should already know the answer, which is to draw your trend line in an area where you can get the most amount of touches, meaning the line you draw will hit both wicks and candle bodies depending on the trend you are looking. So here is your clear down trend. In order to hit all these points here, this is where you would have placed your trend line. Notice at this point here, the trend line is at the weekend, and again at this point here, the trend line is at the weekend. Now at this third point, the trend line is piercing the wick and touching the candle body, which is necessary in order to be able to hit the following point. So again, the trend line hits the candle body, and here the trend line hits the wick and body. Notice how the trend line hits candle closes and wicks, whichever allow us to get the most amount of touches. Price formally broke out and started a trend change, so same along the bottom. Our trend line would be placed like this, because that way we can hit all 3 points. So let's do this one more time. Here is your clear moving down trend, and along the top we would place our trend line like this. Again, weekend doesn't touch, candle close, weekend. Along the bottom we will place our trend line like this. So don't think too hard about this, because again we use trend line as guidance and treat them as areas, not a solid line. Now that you know what trend line are and how to draw them, let's jump into how to use trend line in combination with price action. And before we continue, if you want us to make more video more often, make sure to hit the thumbs up button and comment below with your question and thoughts, and also let us know if you want more videos. So we use trend line in combination with price action in 2 key ways. First is for trending, and the second is for reversal trading. Let's start with the first, which is trend trading with trend lines. Now here is exactly what you want to look for when trend trading with trend lines, which is an area where support or resistance crosses with a trend line. This access point is also what we call an area of high confluence. An area of high confluence is an area where a lot of traders have their eye on, meaning that there is a higher probability that traders will be taking actions at this area, which is when trade opportunity arise. So let's take this one step further. This area is of high confluence because different school and types of traders watching it. First, you would have support resistance traders eyeing this area for possible short trade entries. Second, you would have trend lines traders watching this area for short trade opportunities. Third, you would have price action and candlestick traders watching this area for short trade opportunities. And fourth, you would have confluence traders like us watching this area, knowing all these other traders are here for possible trade entries. All these different types and school of traders with different trading styles all eyeing this area for possible short opportunity is working trigger a possible trade entry short. Now let's break this down step by step of what should be going through your mind as a trader. Also, to point something out, we are only using one time frame in this example, which is the daily time frame. And the reason this is important is because later on this video we will be showing you how to use multi-time frame. So first, you would have established that this is a moving down trend as price was making lower highs and lower lows. so would want to trade with the moving downtrend. Second, you would have identified your trend line through these 3 points and drawn it in and had it stretch up further in case price comes back up to it. Third, you should have looked left and spotted this support turn resistance level and drawn it in. Fourth, you would have then identified area of high confluence where your trade lines and resistance level meet, which means there will be possible short trade opportunities once price got here. Fifth, when price started to approach this area, since you had this area already identified, you are watching to see what price would do once it got here, aka price action. So you are probably thinking, why not just enter trade short right away once price got to this axis point? Again, as a reminder from past videos, it does not matter how good an area is, you do not enter trade blindly once price gets to this area. You always wait for price action because price can easily blow right through. So you then had a reaction to the level through these two red candlestick, not breaking through and bounce downward. At this point, there is still no trade short because of reaction through an area does not equal to reversal. It could just bounce or store out of key area and still break right through. Do not forget that this is a moving uptrend. Now here is the trick. In order to enter after a rejection of a key area of confluence, you put a trend line under the immediate moving trend and wait for a break of the trend line to occur in order to confirm that the moving up trend is over and that the bigger downtrend can continue. This is a very important concept to understand because even though your bigger trend is a downtrend, your immediate trend is an uptrend and the moving uptrend can continue and break right through and trigger a larger trend change. This is why it was so important for the short-term trend to be over through the trend line break so that the bigger trend can continue. Now, the most important point here is that the break of the short-term trend line occurred after the rejection in bound from the area of high confluence, or else you would have just had a short-term trend like break and nothing else. Now, this is a lot to take in, so let's recap this one more time to drop the points home. First, your big picture trend was a downtrend, so you had a big picture bearish bias. The problem is your short-term trend was an uptrend, meaning price is currently moving with bullish momentum. It can easily break right through your long-term trend line. This is why we needed to wait and see if we could get bearish price action to occur inside of the short-term uptrend so that the short-term trend would be bearish to match the long-term bearish trend. Your bearish price action then came in two parts. The first was the reaction to the access point and the area of high confluence, but more importantly, the confirmation of this was through the break of the short-term trend line, and at this point the short-term trend was bearish and matched the big picture because bearish downtrend. You could then take a trade on the break of the trend line and trade to the intruding time frame through a momentum play or using any of the other strategy as you now have your directional bias confirm short or down. Now here is where you take your trading to the next level. If you had good candlestick pattern that form at this axis, you would have placed a very short-term trend line up tight like this and waited for a break of this tight trend line on the lower time frame and taken even earlier entry, which we will get into right now. So in this example, we are going to show you the same concept but take it a step further and apply usage of multi-time frame. Now this is the daily time frame. We first identified that this was a moving downtrend through the lower highs and the lower lows, and again we wanted to trade with the dominant downtrend. you had your imperfect trend line established through these points here. You had to draw in and extend it further down. To the left, you had your support turn your resistance point here. So you had your level drawn in and extend it further out. Again, these points here is where resistance and the trend line intersect and will be your access point, an area of high confidence. Now, as price came up to this access point, we had no idea where the price would break through or reverse, because again, the short-term moving trend is an uptrend. Your big picture trend is bearish and the downtrend, while your short-term trend is the bullish and an uptrend, which means you have a confidence in your direction of bias. So in order to solve that, you need to wait for bearish price action to present itself inside the short-term trend to confirm that the short-term trend is over, or else there is no trade. Now, the first thing we do when the price gets to this access point, wait for some form of price action to present itself. You don't know if there will be price action forming at all. In this case here, the price action information we got was a hanging candlestick, which shows the price indeed reacting to the level. But again, a reaction does not mean equal reversal. So here is where you take your skill and hop on it. Since we had a candlestick reaction and formation at this access point, we then put a tight trend line in like this. The problem with tight trend line is that they can often lead to fake breakouts. So how do we get around this problem? We use a lower time frame, specifically the 4-hour time frame, so that we can see deeper into this immediate trend. So let's put the 4-hour time frame beside our daily time frame so we can see both simultaneously. So here we have both time frames side by side. This chart on the left is your daily time frame, meaning each candlestick represents one day. The chart on the right is the 4 hours time frame, meaning each candlestick represents 4 hours time. Here is the resistance level in the daily time frame, and here is the same resistance level on the 4 hours time frame. Here is a long-term trend on the daily time frame, and here is the same long-term trend line on 4 hours time frame. Here is the short-term trend line on the daily time frame, and here is the same short-term trend line on the 4 hours time frame. On the daily time frame, short-term uptrend, you couldn't see much, but now on the contrast on the 4 hours time frame, you can see so much more details. You can actually see the swing highs and the swing lows of price. Now that you understand multi-time frames, let's recap this all. You had a big picture downtrend, meaning a long-term bearish bias, a short-term uptrend, meaning a short-term bias, which means you are conflicted in your direction. Once price gets to your access point, an area of high confidence, you need price action for a trade short. Since you had a reaction to the access point through the hanging candle, you put a tight trend in. But because on the daily time frame you cannot see deeper into the short-term uptrend, you need to use the 4-hour time frame to look deeper into short-term uptrend. Here in the 4-hour time frame, we were then looking for a trend change on this moving uptrend so that the short-term uptrend could turn bearish to match the long-term bearish downtrend. You have a run, pullback, a run, a pullback, a run, a pullback, and a run. This is your clear uptrend because price is made in higher highs and higher lows. So here is it. Price can break the short-term trend line, which is your bearish signal number 1, and then makes a lower low your bearish signal number 2. You will now have bearish price action that enters the market, confirming that its short trend uptrend is over and the longer term downtrend can continue. Now again, there are many ways to enter the market. You can enter right on the break, your momentum play using the lower time frame, but the most important part is that your direction bias is confirmed now as down and short. So the key here is that all occurred after the rejection and bounce from an area of high confidence, or else you would have just had a trend line break that would be meaningless. Why is it important to use the 4-hour time frame to look for a trend change after the rejection of your access point? Well, because without the trend change or trend line break, price could have easily done this instead and kept making higher highs and higher lows, and kept rejecting the immediate short-term uptrend and broke right through the long-term trend line. Let's take this concept a step by step further. Now, in this example, we will show you another trick you can use if you are a longer term trader, which is, instead of using the daily time frame and 4 hours time frame, using the weekly in combination with the daily for swing trade entries. So this is the weekly time frame and this is the daily time frame. Remember that in our previous video we stated that things you find on the weekly time frame hold more weight. So let's go through the process again. Here in the weekly, you have the clear moving downtrend as price is making lower highs and lower lows. So you want to trade with the moving big picture downtrend. You then had your trend line established through these 2 points here. You had multiple rejections and your support turns resistance zone here. Here is your access point and area of high confidence where the trend line and resistance cross. Once price got here, you had 2 weekly candles that failed to break through, including a bearish red candle that rejected the weekly resistance. Again, bounces and reactions don't trade, so we put a short-term trend line below the immediate trend. Now, in order to look for short trade entries, you need to confirm that the short-term uptrend is over. So we need to go to the daily time frame and look for a trend change and bearish price action inside of this current moving uptrend before looking for a trade entry short. Now here is the daily time frame. This is your same trend line from the weekly, the same resistance level from the weekly, the same access point from the weekly, and the same uptrend and line from the weekly. So here is your moving uptrend where you have a run, a pullback, a run before you had your break of the trend line and lower low. You can start looking for trade entries short to a breakout into the entry. Again, the key here is that they all occurred after the rejection of an area of high confidence, or else you would have just had a trend line break and that would be meaningless. Now we're gonna take it even more step further. This is where we introduce true top time analysis. We will be using 3 time frames, starting from the weekly to the daily, then to the 4 hours time frame. So starting with the weekly, we were in a clear moving downtrend. Here, where is the weekly support turn resistance? Here is your trend line and here is your access point. Now, after you identify all your levels on the weekly, you jump to the daily. Here on the daily, you had a perfect long wick candle rejection of your access point, meaning a rejection of both the weekly trend line and weekly resistance, but again, still no trade unless we have confirmation that the short-term uptrend is over. So we go to the 4 hours time frame to find a trend change on the short-term moving uptrend. Here in the 4 hours time frame, you have your weekly and daily resistance, weekly and daily trend line, and weekly and daily access point. You then have your short-term trend line here, and once price hits the access point and then breaks the short-term trend line, your short-term trend turns bearish and matches the long-term bearish downtrend. And this is when you starting looking for trade entries short, as all time frames have bearish and confluence. So now that you understand how to use trend lines for trend trades, let's move on the second way of how to use trend lines, which is through reversal trading. Now before we continue, this video takes a lot of time for our team to create, so if you are enjoying the video and want us to continue to make more videos, hit the thumbs up button and comment below with your questions and thoughts, and we will work our best to answer all your questions and create videos around your requests.
Welcome back. It's another day. Sure, live trading is when you actually confirm if truly your trainer is a mentor. I mean, being a mentor means if truly your trainer is teaching you whatever he or she is practicing on a daily basis. Are you getting the point? If not a mentor, you will only be an advisor. I mean, someone who only needs to teach. Are you getting my point? So with that being said, dive to our computer and we analyze some chart before we navigate our trade as normal. So it's another day episode. And also, let it be a new energy for us. So let's go. I believe you all have tuned on to you have all put your computer on magnifying screen. I mean, if you are watching us from our YouTube live now, magnify your screen so that you can see all the candlesticks working perfectly fine. I mean, and also, if you are watching from YouTube.
Before we continue, let me quickly share this amazing opportunity with you as well. Do you know that you can also join our Edumers live trading streaming network with our boss Johnson Job to grow your little capital on daily basis as you continue learning to become a professional day trader like us? There is a paid access streaming page on our official website at edumers.com that will help you join this daily program with a secret password. And as a beginner, if you are afraid of losing your first little capital, then this live trading program is for you, because it won't only grow your little capital but will help you grow your confidence until you start trading alone someday as a professional trader. So if you are interested, click on the second link in the description of this video or contact Johnson Job through the WhatsApp number displayed on the screen to learn more about how you can pay and get your secret password to join the program as well. So in this section, we are going to go through a reversal trading strategy with trend lines. Now what you do is you look for key price action patterns that have formed right before a trend line break. Now there are many kinds of price action pattern you can look for, such as wedges, triangles, combining price action patterns with candlesticks, and so forth, as they are a lot. But for now, focus on the two: the double top or double bottom price action pattern and the trend change price action pattern. So let's start with the first, which is the double top or double bottom. Right before a trend line break, you first identify your trend line to this point here. Now this is a clear moving up trend, and reasons you want to identify a reversal price action pattern right before a trend line breaks is because you are going against the dominant uptrend. What this means is just a trend line break can often be a fake out, so we like to pair a reversal pattern as an early signal of possible big picture trend change, but then to pair it with the trend line break as confirmation. The price action we got was this double top, which is a reversal pattern. Now what does the double top tell us in terms of the uptrend? Well, it shows that price fell to make a higher highs, which means loss of momentum. If you have seen our previous videos, many traders would have taken a trade right at this long weak candle rejection of resistance and then waited for trend change. But for most secure traders, what you can do is wait for a trend line break to confirm that the uptrend is over. This is also a good example of why you should never chase trade. As you can see, there is always another trade opportunity right at the double top, but also had opportunities to enter to a breakout strategy after the trend line break. Now if this were a downtrend, you will look for a double bottom. So let's jump to the part we look forward right before the trend line breaks, which is a trend change price action pattern. So in order to spot a trend change, you look for this trade. Specifically in an uptrend, you look for lower highs or lower lows to occur right before a trend line break, and in a downtrend you look for a higher low or a higher high to occur right before a trend line break. So here is your moving uptrend, and we place our trend line below the uptrend, connecting these points here. You have your run, pull back, run, pull back, run, pull back, run, and a pullback. At this point, join the trend. You have a clear uptrend as price is making higher highs and higher lows. It is not until you have your lower highs from here, which is when you will think to yourself that a lower high in an uptrend shows loss from momentum. Once price embraces the trend line, this confirms the trend change and shows bearish momentum entering the market. The reason you want to look for reversal price action pattern before a trend line breaks is because it shows momentum loss, which is important when you go against a strong trend. So let's take this one step further and add in multi-time frame analysis to this concept. So here on the weekly time frame, what you will have first identify is that this was a moving downtrend. You then identified your trend line through these 2 points here. You would have then identified its double bottom through these 2 points here. So what you do is you want to jump down the time frame through the daily so you can see more details into the price action that is occurring within this double bottom and look for a trend change price movement. So here on the daily, you have the same trend line from the weekly and your same area of support from the weekly. Here is where the double bottom occurred on the weekly time frame, and again we see a lot of details on this daily time frame. Again, in order to confirm the weekly double bottom reversal pattern, you want to also look for bullish price action that shows a trend change from a downtrend to an uptrend on this time frame, and you got this through the following things. You have your clear moving downtrend through the run, pull back, run, pull back, run, price and fell to make a lower lows and made the same low, showing a loss of momentum. So you have a double bottom inside of a double bottom, and then a higher high, which is the first sign of possible trend change. You then had another higher low, which is another trend change signal. So this topic is of using multi time frame and time frame confluence gets even deeper and will take too long to completely explain them in this video, but we will continue to build on it in future videos. Now this is very important point. We want you to understand which is the trading comes down to the simple concept of trade quality, meaning they are low quality trades and high quality trades. The more you learn is the more you can see which then allows you to choose between okay trade and high quality trades. Think back to the past videos where we showed you the importance of candlestick patterns and the levels and of course you can enter just like that, but those are average quality trades. What you want to do is to take high quality trades, and knowing the content we've introduced in this video will help you build towards that. Increasing trade quality is knowing when not to take trades, which is just as important as knowing when to take trade. So if you enjoyed this video and want us to make more videos frequently, make sure you hit the like button and also comment below with your thoughts and what kind of topic you want us to cover, as it lets us know you want more videos. Thanks for watching, and I will see you in the next episode. Bye.